The broadcast is now starting. All attendees are in listen-only mode.
Yes, so welcome again, folks, to those of you who were here earlier. Thank you for your patience. It's now allowed anyone who wants to get in, and we're now 5 minutes past the starting time, but we had quite a large number of people who were waiting to get in, so I thank you for your indulgence, and good morning to our friends in the Northern Hemisphere, and well, good evening, I should say, to you, and certainly good morning to those in the lands down under, although I think it's past midday in the shaky isles of New Zealand. Nice to see so many familiar faces here. Shift is with us, and Scotty, and lots of people, and Marcel, all our old friends, and a lot of the new members as well. And we've just got a lot of stuff to tell you today. Some of which I was trying to get through at the last webinar and didn't get to it. So one of the things I said to you at the last webinar is that I think this fractalian is going to give some business opportunities to some of you, and then I never got around to telling you what they were. So for those of you who remembered those comments, my apologies. We'll certainly get to deal with it today. So we've got a number of things we're going to do today. I'm going to spend a few minutes for Brian talking about the contra signals, about which there is a bit of confusion. I'm going to run through this PowerPoint, which has some important new information on it, then I'm going to talk to you a little bit of length about forecasting, which are the markets to be in. Now, this is a new idea for most of you. It's a very old idea for me, but we've never had the tools to be able to demonstrate this to you, or to give you the tools to make the choices. And the traditional thing is we and others have a number of markets. We have more than most, in fact probably more than any, but you stick with the markets you're in, and you go through the good and the bad, and the good is great and the bad is downright lousy. And a much more sophisticated way of trading is to select the markets that you think are going to be the most rewarding for you. This is a pretty vital part of trading. As I say, we haven't talked about it or offered it to you before because we simply haven't had the tools to give it to you in a practical sense to allow you to make those choices. But as you will see by the end of this webinar, if you can move into the markets that are about to show significant price action and move out of the markets that are dull, you will change the whole profile of your equity curve. And with the fractalian and the other programs, you'll be able to use this program I'm going to use today to make informed decisions about markets in any of our programs, and I think it's very, very exciting. So let's move on. The first thing, as usual, let me run through the PowerPoint I have for you, and let's get around to all of those things today. The first thing to tell you is we've now finalized the dates for our Daniel Code tutorial. It's going to be the 26th to the 29th of May. That's the week straight after the Memorial holiday in the US, which is on the Monday. And the format here is the 26th is the Tuesday. We have a welcome cocktail party, very informal, but we like to let everyone say hello to everyone and get to know who's going to be there with them and be their collaborators during this 3-day tutorial. So that's on the evening of Tuesday the 26th. You're wives and girlfriends and others are very welcome to come along. And then we have full-day teaching sessions on the 27th and 28th, and a half-day trading session on Friday the 29th. It'll be over by 2 p.m. On Friday for those of you that want to make arrangements to get home or elsewhere. Those of you who haven't been to these tutorials, they're very extensive, and they'll take you from the most basic parts of trading all the way through to levels of sophistication on timing and forecasting that haven't been seen anywhere else. And we'll start with the basis of trading from charts in futures, Forex, stocks and ETFs. Now, stocks and ETFs are very new to me. I traded stocks extensively 30 years ago when my father was alive. He was a great one for stocks, but since then I've had no interest in them. We found pretty much by accident that this Fractalian program seems to offer quite a lot of potential with stocks and ETFs. So I'm going to talk to you a bit about that later today, and I'm certainly going to be teaching those trading techniques at the LA tutorial. So we start with the manual trading with entry and exit techniques, sophisticated targets and stop loss management. We'll move on to building an auto trade program and show you the benefits from management and market selection in those programs. I know some of you are not terribly fussed about auto trading, which is why we offer both of those alternatives. We'll then move on to market timing and why time matters. For those of you who haven't already, please check the articles tab at the Daniel Code website, and you'll see in there 2 articles. They're all articles I've had published. The 2 important ones for those interested in market timing are called Masterclass 1, it's about time, and Masterclass 2, Timing Gold. And there was an interesting article in Zero Hedge yesterday about market analysis with Sprott Management, who are people who are very, very big in the gold business. They're large purveyors and supporters of the gold conspiracy market suppression theories, which gold bugs seem to love, and I've had a few run-ins with them over the years when I've published material saying that none of that is true, but it doesn't really matter. They're very decent people, very knowledgeable, and they published an article yesterday saying 95% of market analysis is exclusively on price, and for the reasons they set out there, it's nearly all wrong. Well, I think it's probably closer to 99.5% is on price. Very, very few people understand or are interested in time, and that's what makes the Daniel Code very different. And those of you who follow the fourth seal or have been to tutorials or seen my calls for major turns in markets over the years will understand that having a knowledge of time and how it affects markets is a vital edge that very few people in the world have or understand. And we'll then move on from that to the more advanced stuff. We'll show you how to construct and use the fourth seal on everything from daily charts to long-term forecasting. And then I put in there as the next item, 3 days and nights with John Needham, one-on-one sessions, and ask any question you want. Now, you may not want 3 days and 3 nights with John Needham, but the point I'm trying to make is as these Daniel Code tutorials go, we spend the day together, then we have lunch together, we have drinks together after tutorials, and on most nights we all join together to have dinner together. And I'm there all the time, and I'm with you and available to talk to you. We have one-on-one sessions so that we can just talk through as we go any particular issues that individual people have, remembering that we're going to take you from the most basic parts of trading up to the peaks of the high mountains with the level of sophistication. And the reason I do it this way is I want to make absolutely sure that each of you get it as we go along. And of course, after that we have a number of dedicated webinars just for tutorial people to make sure they're all on the right track. And amongst the other things I'll teach you is GMAG, our celebrated continuous trading system, which we've been running for a number of years now, and quite a number of the people who are here with us today trade GMAG, and it's a very, very profitable program. So the fee is $7,500, half price if you've already attended a tutorial and you'd like to come back. There is so much new material for this tutorial that really you should consider it an almost new experience, but we're always delighted to offer a discount to clients who've been with us before, and some of our people have come back and done 6 and even 7 tutorials. So those of you that we haven't seen for a while, please do try and make the effort to come. You'll find that probably better than 60% of the material is going to be completely new as we've refined our tools and our ability to deliver these programs to you. Okay, this is where it's going to be. This is a picture of Manhattan Beach, Los Angeles. This is only 1.5 kilometers from the hotel. It's just a very short drive, and from where we're standing there behind you is the little village of Manhattan Beach. Maybe it's a part of a small township, but it's absolutely very trendy. That's full of shops and cafes and very good restaurants, as Jerry reminded me a few days ago, and we'll certainly be there, and I take the whole group out to dinner, and we have a good night out here. It's a lovely area. It's not at all what you'd expect from Los Angeles. We've actually had a tutorial at this place before. This is the Hilton Garden Inn El Segundo, and it's less than 15 minutes from Los Angeles Airport, and about 5 minutes from Manhattan Beach, and they do make life very easy for you. Once you're booked in and they know your timetable, they'll actually send the hotel bus just to pick you up from the airport and take you there and get you settled in. So we've been there before. We had a great time. They've got wonderful facilities, and we don't do these tutorials very often, folks. The last one was at Waiheke Island in December 2013, so it's 18 months since we've done the last one, and we won't be doing, I don't do them very frequently now. I'm just, too busy. So if you want to do a tutorial, get along to this one, please. Okay. Terry, are you still seeing my screen all right? Shifter said that he can't see the screen. I don't see any problems from this end. It all looks okay. Yeah, Terry can see it. Volume's good. So Shifter's having a problem. Okay. So let's talk a little bit about how we're going to get this Fractalian off the ground. I was hoping to have trials of Fractalian starting literally in the next few days for you, and I'm not going to do that now, and I'll tell you why. We're going to just have to push this back a little bit because there's a few issues that I'm still not comfortable with. One is that we found a great many new markets, some of which are tradable, others of which are not, and we have to really get a grip on that. I have found also that the 2-week free trials that we offer you are not really enough for you to make a proper assessment of the system and to understand it. And as a case in point, I've had a very nice gentleman did a trial of one of our programs, Genie, I think. He made $18,000 during his trial on his SIM account. He was absolutely thrilled, signed up for it, and then got disappointed. What happened, as it turned out, eventually was that he'd made 15 of that 18,000 in one trade that had gone on for days and days, and he sort of took that as the standard, and then was disappointed when he went back into the other phase of trading, which is more the daily battle, which we understand. That's a big issue. The other issue is that, I get deluged with emails that people are happy with new programs that do well and unhappy when they don't. And basically the 2-week trial, I think, is just not long enough for you to really get a feeling of it. Now, one of the things that we're introducing with Fractalian, and I'm going to teach you in the next month or so, is how to forecast surges in profitability that come into markets. And I'm going to show you how to determine that for yourself. And that's going to take a few weeks. So what we're actually going to do is we're going to start trading these markets on a sim account. We're going to show you exactly what happens with them all probably over the next month or so. And then we're going to trade some of these markets on a live account to ensure that there is enough liquidity, get a better idea than we have now of slippage and those sorts of issues. And so it's going to be 4 or 5 or even 6 weeks before you guys will be able to have this. But don't be disappointed, because the way we're going to do it, I assure you, is going to be much better for you. And there's a whole new process of learning about forecasting which markets you should trade. What we're saying here is, once you have a trading system of fixed rules, and there's nothing more fixed than an auto trade program because you can't muck around with it very much, then your profitability is determined by market selection. And this is a pretty radical idea. With almost everyone, you find a few markets that you like and stick to them. There are a lot of people who like gold. There are a lot of people who like the S&P E-mini. They're the most popular ones, and that's all they want to trade. And the pattern of their life and the pattern of people like us who provide advice has been that we simply haven't had the tools to give you to allow you to make informed decisions about which markets you should be trading and which ones are going to be the most rewarding. And I'm going to start that process of showing you today, and we'll do that over the next couple of webinars so that you really have a good handle on how to use this very, very sophisticated tool, which is the Fractalian backtesting tool. We really need you to understand how to use it, which is my job to teach you that over the next few weeks, so that when you do start your trials, you'll be really able to take full advantage of what I think is a very, very exciting program. The reality is that patterns in markets determine profitability, and those patterns come and go. And markets will have long periods of time of good profitability, and they'll have long periods of time where they're dead and dormant. And for most people, you just have to trade through the dead and dormant, stick to the program, and wait for it to come good. And that's pretty soul-destroying for a lot of people. And it's also detrimental to your financial health. So this is the first time we've had the tools available to allow you the flexibility to take advantage of these market surges that make the money. And these surges, they are reasonably predictable, but they are contrary to almost everything you believe. So it's just going to take a little while to get that through to you and let you have an understanding of it and of how to use these tools. So one of the things that we've seen is that, one of the things we've seen when we got this new program, Fractalian, which for those of you who missed the previous webinar, is not new. I've had it for years and years. In fact, it's the part of the program, one of the major parts of the program that creates the TO3 and plus signals. But it's always had to be done manually, and so I haven't been able to really explain or offer this to you very much. I have taught a form of Fractalian at previous webinars, and Sister Sage, who many of you will know, tells me she uses it every day to scan and analyze 52 Forex markets. So for those who've done a tutorial and are using it manually, they're already way, way ahead of the game. But this sheet I'm showing you now, we started off by running a scan of all of Trade Navigator's 067 chart, and the 067 code, for those of you who are not familiar, is actually the continuous markets code. It's the one that Trade Navigator prefer because it takes the rollovers and makes them seamless. it's the best way of testing these sorts of programs. So we've seen some really interesting things in here. If you start at the top and you see G6S, that's the futures contract for the Swiss franc. And if you go over to the net profit, which is over in this line here, I'll see if I can get my spotlight up for you, which is here. So here's your net profit factor. You'll see that 12 months trading, this is from March 2014 till today, or yesterday for me, today for end of trading today for you folks. This futures contract in the Swiss franc made $37,600, to which we say, whoopee, that's very nice. But if you look at it a little closer, you'll see that in there it had a large win of 25,700. In other words, the vast majority of its profits for the year came from a single event. And we view that very suspiciously because we don't know when those major events are going to happen. They do happen. They're very nice if you're on the right side of them, as we almost always are, but that's not, for example, a market that we would be terribly interested in trading for. When we look at this sort of analysis, we deduct the large win from the net profit to see what it's done elsewhere. If you move down to this line here, you'll see ZD, as we say it, or ZD, as you probably say it, and that's the Dow Jones contract. That's the medium size. It's not the mini contract, and it's not the $25 contract. That's the normal Dow Jones contract. And it's a very good market for us. It made $45,000 in that year on a margin of about $8,500. But it doesn't trade. It's not liquid enough to run an auto trade program. Similarly, here's another market that I used to trade. LB is lumber. It's another market that's very illiquid, and to run these sorts of programs where there's a lot of trading going on, as you can see from the number of trades, it's trading every second day, sometimes 2 and sometimes 3 or 4 days a week. We need to make sure that the markets have sufficient liquidity in them, that we get in when we want to, get out when we want to, and that slippage does not become a major factor. So we need to just be sure of all of that. Here's a new one down here, RL, another one we haven't traded before. That's actually the Russell 1000. We trade the Russell 2000 TF. RL is the code for the Russell 1000 index. It has a margin of $3,700, and on the hypothetical testing, remember everything that I'm showing you is coming from a computer generated product that has no knowledge about market conditions. It doesn't know about liquidity or whether there was sufficient action in the market to get filled, and it takes the prices at which it wants to enter and assumes those fills. So as I've said to you before, you have to discount hypothetical results to allow for that reality and the reality of commission and other expenses in trading. So we know nothing about this market really at the moment, but it looks a very good market, and I really need to find out more about these markets, which we will by first of all sim trading them and then trading them in a live account, and we'll share that with you as we go. So by the time you get around to running trials, you will understand very much better how this program works. Just the last couple of points I want to draw your attention to. If you go right to the bottom of this particular screen, you'll see that ES, the S&P E-mini, was lousy, lost $4,000 for the year. EMD, the mini mid-cap contract, was worse, lost $15,000 for the year. And the very worst of all these markets was the Russell 2000 TF, which on these figures lost $22,500 for the whole of 2014. So I just want to bear that in mind, because that will become important as we move along in today's webinar. So that was the futures, and they're not all the markets we're going to trade, but I want to point out to you new things we found that require more clarification and understanding. We've done some initial testing of this program on Forex. I know a lot of you people are very interested in Forex, on the whole of 2014 figures, these are the best results that we've got out of Forex, and some of them are sensational. Now, I know a lot of these markets are very unfamiliar to you. They're not our traditional markets by any means, but almost all of them are available to trade. And as I said, Sister Sage now trades 51 or 52 Forex markets using the manual version of Fractalian. And as you can see, some of these markets are very worthwhile. So we want to make sure that our development's going ahead to bring Forex to you, which I suggest will be a number of months away, incidentally. The other most interesting thing that we found with this program, almost entirely by accident, is it seems to work very well on stocks. What I've given you here is a run for the last 12 months of stocks from the list is taken from the S&P 500. So we know that most of them are big stocks, and we think that nearly all of them are quite liquid. Now, to try and put this in perspective, let me take you to the this figure here, which shows you the returns. Now, as I said, I haven't looked at stocks for 30 years, but I've done a little bit of research around here, and the best mutual fund that I can find is one of Vanguard's fund. It's called Vanguard Prime, and it's returned 18.5% for the 2014 for the year to date, which was about a week ago. So these figures run from March 2014 to a couple of days ago, you can't compare this program long term to mutual funds, because all mutual funds include compounding, dividends received, and that sort of stuff. So we have to do it on a year-by-year basis. But in a very, very hot market, this Vanguard Prime Fund appears to me to be either the best or one of the very best, and it's returned 16.8% in a hot market. And as you can see here, we have about 60 of these stocks that have done better than 20%. Some of them have done very much considerably better, and we have about 180 of them that together will average better than the best returns in the Vanguard Fund. So we've got some steps to take with this. We need to understand more about liquidity and markets. We need to find somebody who's trades stocks, who's interested in stocks, who's knowledgeable in stocks. And for any of you that fall into that category, that's your stocks traders or knowledgeable about stocks, or you know a broker who is, please get in touch with me, because it may well be that we can supply this material to you, and you folks can think about setting up businesses to market this stocks trading program. It certainly appears worthwhile, but I don't have enough knowledge about it, and knowledge is not something that you acquire in 2 days swanning around doing Google searches. So any of you that are into stocks or have brokers that are into stocks, apparently futures and Forex and stocks brokers are entirely different creatures. So I would like you to get in touch with me. Let me know your ideas. Any brokers you know who are interested in stocks, please put them in touch with me, and let's see if any of you can put together a business model where you can take this research and trading results and turn it into a product. In other words, you can set yourself up as a business in this. But that's what we have initially for you, shown that. It's pretty exciting. The thing to remember is that costs really matter. For stocks and ETFs in particular, you have a lot of trading on relatively small average trades, and if you start putting on big brokerage, together with your other costs. You've got FINA, you've got clearing, you've got all sorts of ancillary charges. You can kill these returns pretty dramatically. So if you are a stock trader, you really need to shop around to find the best commission structure that you can. And the best I've found is Interactive Brokers. The link is down there for you to look at. And they're at, on their tiered graduated system, they're at 35 cents per 100 stocks, which, depending on how much you trade, gets less and less as you trade more. So that's a big issue for stocks and ETF traders in particular. Here's ETFs, which is something also new to us. Again, accidentally, this comes from the Fractalian program, which I designed many years ago for futures, but it seems to work pretty nicely on ETFs. There will be people amongst you or your friends who don't like trading futures for one reason or another, who like trading ETFs, and as I say, I know next to nothing about them, but this is what the program's told us. And if you look down the returns, I put the highlight button over the top. Excuse me, they look pretty fantastic. Now, I don't know if there's any liquidity in these ETFs. There are thousands and thousands of them. I have pulled out a list of the 100 most popular ETFs, and they do have good returns. But the more popular the ETF, as we often see, the more muted or subdued those returns are. So the trick with ETFs, I think, will be to cobble together a portfolio that gives you lots of liquidity, and a lot of the big ones where you're comfortable, there's liquidity and good NAV, and then maybe add a few a little spicier to up that ante. Now Max just sent me a message that in Interactive Brokers, he's had a difficult time getting their trading program well integrated with Trade Navigator. Mac, there's all sorts of issues. Any broker you mention, someone will say it's great and easy, others will say it's difficult and they're not so great. There's been a lot of noise around Interactive Brokers because they've been such a fast-growing firm, and they really are right into cutting-edge technology, and it's in fact technology that's allowing them to offer these very, very much cheaper rates. If you go to that link I've given you, you'll see that they not only give their rate, but I mean their base rate without tiering. There's $1 per 100, and you've got E-Trade and Barclays and those on $6, $7, and $8 a 100. So they are just miles and miles ahead of anyone else that I'm aware of on commission for stocks. So I can also tell you that they were one of the very first people to get the back end of Trade Navigator. So they've had the Trade Navigator API for years and years, and there's no real reason why you would have trouble getting that integrated. But by all means do let Trade Navigator know, because they've been involved with Interactive Brokers for many years. So there's ETFs, folks. That's just a quick scan. As I say, no idea whether these particular ETFs are tradable or not, but I know that there's an awful lot of them, and what we'll look to do is put together a portfolio of liquid ETFs that are big enough and trade often enough to support an auto trade program. Although don't forget, you're going to be able to trade Fractalian either as an auto trade or manually, and I do know some people who simply don't want to trade with an auto trade program. They find it too complex, and they'd rather just trade manually. So don't forget that. So let's move on to forecasting tomorrow, and I've just put some sort of general thoughts here. I am going to deal with this at length when we finish this section of the webinar, and almost everything we believe about forecasting is wrong, and basically folks want more. Most people think more is better. and long periods of backtesting equals more stability. My friend Jerry, for example, wants 2 years, 3 years, or 4 years of data. Dana, who's been a member with us for many years, he's a very methodical naval officer who also believes the future can be divined from the past, and he'd like to see lots and lots of data. I'm an attorney, and for attorneys our lives are built on precedent. In other words, whenever we get a case, the first thing we're doing is looking at the legislation, if there is any, and then we're running to what we call the case law, where we look and see to what the superior courts have decided about this particular issue in the past, which will then be guiding, if not binding, on the existing matter. But we're all wrong about that. We get this idea that the past tells the future from Ecclesiastes, and your mum and dad probably told you, and I mean the reason we think the sun will rise tomorrow is because the sun's come up for the last X number of days of our lives. So we're conditioned to believe this, and it is logical the way our minds work that we say, let's have a look at 1 year, let's have a look at 2 years, let's have a look at 3 years. And at the last webinar, I actually showed you a whole lot of markets with 3 years results, and I have that sheet here and I can show it to you again, but it is wrong. And one of the things I'm going to start doing today and do for you over the next few webinars is I'm going to show you why it's wrong, how you can make it right, and once you grasp that, you're going to have a very high probability of being able to focus and forecast on those markets that are coming into their time of valuable performance. And the corollary is, of course, that you will be able to avoid many of those markets that are dead, dying, or just sleeping. Here's our compliance statement, folks, I want you to read. Particularly, I always draw attention to this hypothetical performance because everything I'm telling you comes from computer programs, almost everything. Sometimes we actually go to the charts and see things, but you must be aware of that, and that means you need to make allowance for commissions, other fees, and slippage. As usual, here's our sheet on free trials. If you'd like a free trial of anything, you can just ask Terry, support@thedanielcode.com, and you can go ahead and register, and we can organize free trials of any of our programs for you. Okay, so that ends the first part of our webinar, we can get out of that and that, and we can now move on to our charts. The first thing I want to do, I had a couple of emails last week from Brian, who was talking about a couple of Forex markets. Just let me look at that on the other screen. Okay, so Brian was talking about Euro USD and GBP USD, and he was talking in particular about the contra trade. And if you go back a few months in our discussions on trading the TO3 and the plus signals, there are a number of occasions when it's wise to take the contra trade. In other words, if we have a buy signal, take a buy and sell signal as well. And I want to just clarify that, because that does not apply willy-nilly. It only applies when circumstances set up for you. So let's first have a look at the Euro USD, which gives you a better example. Now, anyone who's been to a tutorial will understand that the very first things, I say this at every tutorial, a lot of you guys haven't been to tutorials, and some of you have been to tutorials still aren't doing it, but the very first thing you do with your charts is you put on the Daniel Code trading channel. Now, there's a whole webinar with nothing else except how to put this on and how to construct it, and you need to know those rules. And if you don't know, please find that webinar, or better still, come to the tutorial and I'll show you how to do this stuff, because it's vital. Now, we use to do this button over here. That's a dollar sign with a couple of, maybe it's just the markets going up and down, and Trade Navigator call it a regression line or a regression channel. Now, we don't use it that way, and if you do use it that way, it's completely useless, because basically what it does is it goes on and on opening up until it fits every situation, and then it tells you nothing. We convert that into a Daniel code trading channel, which had some very, very specific rules. Now, I'm showing you this on a daily chart. We use it extensively on weekly and monthly charts, which we're going to review very briefly to show you where the equities markets are and what they're doing. The rule is that we can start this at any low or any high, and we have the choice of starting at either the chart low, which is where this bar is now, that's January the 26th, or if you prefer, you can start it at the closing low, which is January the 23rd. Now, this is part art and mainly science, but the irrevocable rule, inviolable rule, however word, is that to make it a valid Daniel code trading channel, it must maintain contact with the first reaction out, which is this bar here, 0127. So we have three lines here. We have the blue line through the middle, which is the median. We have the upper first trading channel and the bottom of the first trading channel. And if we right-click on this and wait a moment for the program to open, you'll be able to see that we use a standard deviation value of 1.593. Now, Forex markets will often use 1.625. Which is the next number in the Daniel code lexicon. These are Daniel code trading time and price ratios, and everything in markets works off these ratios. There's the difference between 1.593 and 1.625 is so small that you probably don't have to worry about it. But the main thing you have to remember when you do this is that you don't click this button. The dynamic stay at the end of visible data will just go on extending and extending this, and it gets to the stage that it then becomes a true regression channel, which means it encompasses everything on the chart and it's useless. It tells you nothing. So this rule, the first rule, is that this point, contact with this point, the high of this point, must be maintained, because we want contact with at least two bars in the pattern, including that one. Now, very long runs, sometimes you'll find two others, but what we've done here is just by moving this from one period, we've gone from contact, where we wanted it at the top of 127, to all of a sudden, boom, she's jumped up. We no longer have contact. So that is not a valid Daniel code trading channel. It's now become a useless regression channel. For longer term stuff with major trend changes, we require more than this, which we'll get to. But for your trading, Brian and other folks who are interested in these contra signals, this is all you need. And when we get a confirmed trade, which is a close, outside the first trading channel, we assume that there is a trend change in force. Now, none of this is perfect. Don't forget, we're always dealing only with probabilities. But this is a zero, close to zero times net market, and if you get it right and know stuff that other people don't know, you will just be doing very, very much better. And the rules of the contra trade, based on the fact that corrections in trending markets will not go more than 3 days. Now, that's not literally true. Sometimes they'll go 4 days. But if they go more than 1 to 3 days, you're going to see a more complex correction, and there are a number of patterns of corrections available, and that doesn't help us. We're interested in the 1 to 3 day correction. So from here was your setup for your buy signal. and it's elected, so this becomes day 1, day 2, day 3. On any of those 3 days after a new TO3 or reversal signal is been elected, you can use the contra trade. And that is because our assumption is that the trend will resume. Now in this case, it doesn't happen. You get short here, we're expecting the trend to resume, and it doesn't. Over here is a very good example. You had your 1 bar up here, didn't elect any trade, 1 bar down, didn't elect anything, and here's your up trade. And this elected a turn, and we assume that 1 to 3 bars up is a simple counter trend, and that the trend will resume, which the very next day it did. So that's why you use the contra trade. That is, if you have a buy, you'd also take the sell. If you have a sell, you put on orders for the buy and sell, and let the market elect. That doesn't happen here, and as you can see, the market goes off into a very complex correction that lasts from January the 26th until February the 26th. It's run for exactly a month. The first annual code number in the sequence is 29.6, so that's not terribly surprising. At this stage, we get a close below our initial Daniel code trade channel. Now, let me repeat 2 points. 1, this is stronger on longer term charts, 6-day, 12-day, 24-day charts, but it is also valid on daily charts, and it should be the first thing that you put on your charts every day. And if you don't understand quite how to do it, go to the videos tab here. You'll see a webinar that's dedicated to nothing but Daniel code trading channels, and if you want to know how to get a whole lot more out of them and other ways of constructing them, come and meet me at Los Angeles at the tutorial, which is on in about 2 months' time, and I'll show you how you can just get a whole lot of forecasting knowledge and trading knowledge out of this tool. So moving on, we got to February the 26th, and we have a confirmed break, by which I mean a close outside the existing trading channel. At that stage, we are assuming that a trend is about to resume. So the 2 times we can use the contra trades, Brian, is 1 to 3 days from an existing signal, or 2, when a trend is in force, because once a trend is in force, there's our next, let's run this down here. You can see we're putting on a new trading channel, and as we run down here, all of this period, this is obviously a trend, and we've got the signal way back here on February the 26th, would mean that you can trade both ways. Now what happens in these sorts of markets is that they keep creating signals. As they run down here, they're oversold, they might have no divergence, they might be hitting Daniel code numbers, but for all sorts of reasons they're creating buy signals, none of which get elected, but the sell side of them, which is how you would trade them on your contra signal, is very, very good. So they're the 2 circumstances where you should validly use the contra trade. 1 to 3 days from a Daniel code signal, or when you have a new trend in force or any trend in force. And the way you determine a trend in force is a break of the Daniel code trading channel, a confirmed break, and you'll then see that trend go on. Now, this is the first reaction we, excuse me, we took this new channel down from February the 19th, and as it continues to move, make sure you're doing this manually. We want to keep contact with this bar here, which is February the 20th. It's the first reaction out, and then you get a little rally. And there's always a point for the first reaction, and we want to maintain that contact. So watch what's happening up there. There we had it. We still have contact there. We have second contact down here. That means we have a valid Daniel code trading channel. We go 1 more bar, and we don't have it. Okay, that's popped right away. And we no longer have contact with 2 separated points on the chart. Admittedly, we've got 3 bars down here, but they're so close that's meaningless to us. We need them to be separated by a reasonable distance. Those of you who do nautical navigation will understand that. Excuse me, you need the, or any navigation, you need a line through 2 points, but if those points are very close together, it doesn't mean a lot. The further apart they are, the better. So at this stage here, we have our first close outside the trading channel that we were running in. We now know that that trend is over. It may start a new trend, or it may just consolidate. But that's how you determine when you use the contra trade. Okay, Albert, I've got a few other questions. I'll come back to them. I just need to move on here because we're running short of time, and I've still got a lot that I want to show you. That was Euro USD, and the other question Brian had was GBP USD, and I'll show you the same thing on a different chart. And the point he was making is that there's a whole lot of money to be made down here, and all the way down here this market is oversold. It's hitting divergence, it might be hitting Daniel code numbers, and it's creating buy signals all the time, none of which are elected, and all the sells are very, very valuable. So if you'd come to a tutorial, Brian, or if you, and I hope you are, or you'd looked at the previous webinars, you would understand that up here you had your normal Daniel code trading channel. Here's our first reaction out of the low. This is back on January the 27th, if you can't see where the cursor is, and we must maintain contact with that. That's our first point of contract. When the Daniel code trading channel moves past that, it is no longer a valid Daniel code trading channel. It becomes a normal regression channel, which is useless for the point of forecasting. So we move on one more day, and you'll see how this top line, which is one standard deviation, it's not a normal standard deviation, it's a Daniel code standard deviation, which is 1.593 times the standard deviation, but it's all in this program, as I showed you. It's lost that contact, so this is now no longer a valid Daniel code trading program. You could argue that, look, you have 1, 2, 3, 4, 5 points of contact up here, so it's still valid. If you move it on another day, you lose this. So you've already lost the first point, you now lose the second point. And for daily at least, I don't allow that latitude. I want it to maintain contact with the first point, and that's the last day on which it does so, which means on this bar here, March the 2nd, we have a close outside the one standard deviation downside line of our Daniel code trading channel, which tells us the assumption is, now remember this stuff is not set in gold or concrete or iron or anything else. We're dealing with probabilities here, and we're trading on a daily chart, which is not as strong as a 6-day chart or a 12-day chart, and we're getting clues, we're getting subtle clues, but certainly the clue here is that the uptrend has ended, and we are about to have either a downtrend or a consolidation. So once we know that's gone, we can look to put on our new trading channel, which starts either at the swing high or at the closing high, which is that one there. And we can bring this down here all the way, and you see that we've maintained contact on the downside with this first reaction all the way down. And once you're in this sort of a channel, it was this bar here, I think from memory, that proved to us that the uptrend, or gave us the overwhelming probability that the uptrend had ended, and we're now going to be in a downtrend. And if this thing is going to trend, that is, it's going to stay inside this new regression channel or new Daniel code trading channel, which at that stage, remember, is only back up here, then, and it does there or below is fine. Below just means it's speeding up. Then you can take the contra trade. Now, watch this point up here. This is another low. This is actually a little reversal bar, so that is a valid low. It went down, it came back up, had a higher bar the next day. We need to maintain contact as we move along with this bar here. And as you move on one more tick, you'll see we've lost that contact. This is no longer a valid Daniel code trading channel. It has become a regression channel. So we put that back there. We find as soon as we get this big blowout bar up here, that tells us that the downtrend within that trending pattern is over. But for the whole of this period from this bar here, which was 0302, down to this bar here, 0318, it was valid to take the contra trade. So we can take the contra trade 1 to 3 days after a Daniel code signal, which you get from the website, or if you have a trending market, and that's how we define trending markets. Okay, so let me see what I wanted to move on to you with. I want to start. You can see that time is always an issue for us. Before we move on to showing you Fractalian, I know that all of you will want to see how these markets, the important markets that we look at regularly, are going. Gold, very interesting thing about gold today for you gold bugs. Here's the gold chart. You can see that it went down. It had support at the Daniel code black line. Those of you that actually subscribe as private clients to get our weekly charts will recall that I said it had strong support last week from the 1149.90 black line, and there was another blue line very close to it, and that report went out before this bar had been formed. So it was quite prescient, and from there we got a nice strong reversal and a rally. And I think this week for our private clients, I've said best probability now is consolidation below 1224, which is the 50% retracement of this major swing. And that's pretty much what it's doing now. For you gold traders, interesting today, we have sell signals in gold and silver, and we have a buy signal in Huey. And Huey is the unhedged gold miners index. You can trade it only with options, but we put it out because it's a highly correlated with the gold and silver market. So today those markets did opposite things. Gold and silver went up, Huey went down pretty big time, and gold has got rollover in I think 2 days. So be alert for perhaps a reversal in gold where it's going at the moment. That's an interesting thing. Always be aware when you get correlated markets that are not working as correlated. Okay, let's have a look at S&P, because there's the usual chatter about doom is here, it's all upon us, etc., etc. Well, look, it's not. This 2100 line, for those you don't know, is where I said the market would be in December, and I missed it by a few months, but it wasn't bad. The end of the year actually managed to stick its head up to 2079, and it then went up the next month to hit that 2100 line, close enough, 2093. And what we have here, this is our 12-day chart. It's a very, very strong chart, and you can see that this market has run within this Daniel code trading channel since its low in March 2009. Once it's actually gone down and hit 2 standard deviations, which still maintains a trend in these longer term charts, and on many, many, many occasions it goes back and finds support at the 1 standard deviation. Up here we had a 4th seal line which turned it down. It went to the median, came back up again 1 week past the 59. Now this is not the 59 crash cycle. It's missed it by a week, which is it comes from this outside bar here back on 0418. It is a valid reaction to the time cycle, and it's plus or minus 1 week, which is the variance we allow this particular program. And at this stage, all you can possibly say about this is we're getting a correction, and a very mild correction at that. And if this market wants to correct further, it can go happily down to this median line, which is about 2015. This is on the index, not the futures, and it will continue to hold this trend until it doesn't. And as long as it holds this trend and it's working within that Daniel code trend channel, the trend is up. So our dominant trend in this market is up, even though the trend on the daily charts at the moment is down. And that's what markets do. They'll have several different trends within them, depending on the time that is available. Now, I wanted to move on, folks. We're past time already, and I don't want to bore you with this stuff, but I just want to run a couple of programs to show you the things I've been talking about. This is Fractalian, and this is our backtesting program, which is going to become so important to you, not only for Fractalian, but for all the programs we run. It's a bit of a marvel. It's showing us lots of things that we've known but haven't been able to prove or demonstrate to you in the past. So we're going to search the 067 contracts. These are the continuous contracts, and we're going to run them here for the whole of January, the whole of 2014. It'll only take about a minute to run. It doesn't take long. It's very, very fast, and you can see these just rolling out now. And you can see why I've decided to run sim accounts ourselves for your benefit on these programs, so that we can really get a better understanding of some of these markets. These markets with different numbers in front of them are regional markets. COS, that's the KOSPI, that's the Korean market. The J's are all Japanese markets, so these are all in yen or won, so don't get too excited about the numbers. You have to divide them accordingly. And then from here down, apart from HS, that's the Hang Seng. Soy for you, Daryl over in Mossman, that's Johannesburg market. But for all these others, there's your results for 12 months. And you know, to us, that's terribly, terribly interesting and exciting, because there's a lot of new markets in here that we're not terribly familiar with, and they offer great trading opportunities, but the sort of things that we're now learning, which is why I'm going to have to do a bit more real-time testing and live testing with a sim account to show you this stuff, is take, for example, this market, ZDZD. This is the Dow. I think I touched on this. This is not the big Dow, but it's the $8,000 margin Dow. Looks fantastic. Doesn't trade enough for us to use it. ZE, which is a little bit further down the page here. I saw it some time ago when I was here. Let's have a look. ZE. There it is, right? Now that's LE. We want ZE. Where's ZE? Oh, it's up above. There it is. Ray, you asked this question, and I got really excited about this market. That's ethanol. It's a very interesting market. It does fabulously well on this program. I'd like to very much be trading it, but we can't. It has a variable margin that runs from about 3,000 to 6,000, depending on seasonality, but it often will just trade once or twice a day. So there's nowhere near enough volume in that market for us to trade it, particularly with an auto trade program. So we're going to just have to refine a lot of this stuff with Jerry and with our own sim account to make sure that there's sufficient liquidity on these new markets that we want to offer to you. Now, very quickly, if I can, I want to just get to this issue of forecasting when markets are tradable and when they're not. So let's do this really simply, if you'll indulge me. I know we're over time, folks, but it's important that I start by showing you this. I'll go into it at more length at the next webinar. And we might even have a special webinar just to do this. Let's run for the whole of 2014 our normal markets that we're all familiar with. This is the Fraxen market, so let's just run that. This is for a whole year, and you'll see this all roll out, and you'll see that the ones above the line have been profitable, some pretty nice, others not so great. And the ones below the line haven't been profitable. One of the things you'll see there is the question of whether we should pyramid these accounts or not. Now, that's a separate topic, but I can tell you that if we allow pyramiding under the program, Ray, you were asking about this, it does enhance profitability in most markets, but it can also harm profitability in other markets. So let's move on from that and then go back Let me make sure I did what I said. Yes, I did. We had pyramiding turned off. That's the main thing. So there's, when we run that, if you look at the bottom of this data that's coming up, it only takes a few seconds, you'll see what's really horrible. And here it is. Have a look at it. TF, that's the Russell. EMD, that's the S&P mid-cap. And ES, that's the S&P E-mini. And they go from bad, this is a full year's trading for the whole of 2014, they go from bad for the S&P to worse for the mid-cap to absolutely downright lousy for the Russell. In fact, it's our second worst market. So, you know, if you were taking your 1 year, 2 year, 3 year data on that, you would say, no way am I trading that market or any of those three. And you take them off your list. So let's quickly just move on in time and see what's happened lately. And we can now run, let's run from, let's move that up to a February date, and I'm going to show you a test that starts in February the 27th, so let's run it. But I'll come back and show you the test, but let's just run this from the end of February to the end of data now. That's almost a month. Let's see what's happening with exactly these same markets right now. And when we run that, which is up there now, you'll see that TF, the Russell, is now our very best market. In the last month, the Russell has made $5,820, and it's got a margin of 5,600. It's made over 100% in margin in less than a month. Let's have a look at the S&P, which was dreadful in the last 12 months testing, worse in the 2-year testing and the 3-year testing. And it's run almost $5,000 in the last month. It's not quite a month, it's got a couple of days to go. And it has a margin that's gone up a little bit of $5,000 or thereabouts. But with Fractalian, the vast majority of these trades are day trades, probably better than 85%, maybe even higher, are day trades. And you can trade this market on a $500 margin if you're a day trader. So you see what's happened. That's what's happened in the last month. And there's EMD. Okay, there's the S&P mini mid-cap. It has a margin of about 7,500. It's returned 50% on margin in less than a month. So these are all opportunities with our traditional way of trading, just pick the markets that have performed best and stick with them, that you would have missed out on. But if we can get to forecasting what markets do and when the surge is going to come into them, then we can take advantage of this. Now, I was going to give you a whole 30 or 40 minutes on that, which I need to do, but we're past time by quarter of an hour, so that will have to wait till next week. So next week, make sure you join me for the webinar, because I'm going to show you how you forecast when markets are coming into season or when they're about to give you the big returns that I'm showing you here. So do make sure you come for that, and I can tell you that it won't be recorded, because if folks are not interested to come along and hear that sort of brand new and very much inside information, then we're not going to be broadcasting it to the world. Now, Terry's just pointed out to me next Friday is Good Friday, so it won't be then, but we might be able to squeeze one in earlier. If not, it's still a vital webinar for you folks, and it will not be recorded. It'll only be available to those of you who make the effort to come along. Okay, so questions here. Let me be really quick. Paul, is it possible to trade equities in a Roth IRA through TD Ameritrade? Paul, no idea. Should tell you on Ameritrade's website. If not, talk to Jerry Winter, who's our broker. His contact details are on. He's not a stockbroker. He's a futures broker, but I'm sure he'll have the answer for you. Mac about IB, we've talked about that. And how does the contra trade work if you are following the stop and reverse rule? Albert, It works fine, and the stop and reverse rule is exit first profitable close, which is almost always the day that it happens, Albert. It's not a profit strategy, it's a mitigation of loss strategy, and you can just take the next trade the next day. So folks, that's all I have for you. I do hope you've enjoyed this. I've got so much more to tell you to be hardly true, but this is the key, that we're able to forecast with a high degree of probability markets that have been behaving as absolute dogs, and they come back to life. And I'm going to show you how you can show that for yourself, and it will take you about less than a minute each weekend. So you'll get involved with the stuff, you'll spend longer, but once you have this program that I'm using and working with and showing you, which you will have, you'll be able to make informed decisions on all of these markets. And what we're going to do, which is again very radical and new, is we are going to give you all of the markets. It's going to be about 25 that we're going to approve for fractalian trading. We're going to, you can just buy your 1 or 2 or 3 markets for their average about $75 a month each if you want to. But those of you who are a bit bigger traders, we're going to offer the same package we have in the past, $4.99 for 8 markets, but in fact we're going to give you all of them, 25 of them, and let you make the choices. We will hold your hand, we will make suggestions every week, but you'll grow in confidence as you do this. Okay, Shift is back. He's in Melbourne. Look for me at the Melbourne Cricket Ground as the Aussies grip the Kiwis. Okay, blah, blah. Okay, Hank, thank you. I'm glad you enjoyed it. Matt, glad you stayed all the way with us. Yes, Shift wants me to tell you Americans that he says cricket is just like baseball, and you can take it from there. Anyway, thank you for your attendance, folks. As usual, we've run over time. I have so much I want to get across to you, but this is a great new horizon for us, being able to actually demonstrate how the profitability in these markets changes, and better still, next webinar to give you a good 30 or 40 minutes on how you're going to use this program to forecast that for yourself, not only for Fractalian but for all of our programs. So I thank you for being with us today, and I bid you farewell until our next webinar. Bye-bye.